Talk about macroeconomics. Huh? That's one factor then, right? Immediately, like population dynamics, a very well-known macroeconomic factor, extremely important in the property market, and also fairly important in many other markets, I would guess.
Yeah, and I think I don't know if I actually answered your question about the importance of macroeconomics with investing, but I would say
No, I
sure
haven't asked it yet. We were basically going off a tangent after talking about your credentials.
Well, so to answer it quickly anyway, I would say based on my own approach, again, as a fundamental investor, you can put different weights on macro. For sure, I would think it's silly for anyone to not have a basic understanding of macro because you can see firsthand how drastically the stock performance changes under different situations. Bitcoin, tech stocks, high growth companies all did exceptionally well when stimulus measures were there, and all have since done exceptionally poorly as those stimulus measures are taken away. Now, it's not to oversimplify it. There are other variables to consider, but clearly there's some correlation there that makes intuitive sense. For someone to invest and not have any comprehension of what quantitative tightening is or how rising rates impact the stock market, you're really handicapping yourself in terms of researching stocks, right?
Mm-hmm.
People take different approaches. Again, even within fundamental, there's like top down and bottom up. So top down research is when you say, okay, let's look at all the macroeconomic factors. So, you mentioned Sri Lanka, the US, Canada. So you look at all these countries and you say, okay, well, Sri Lanka's in a troubled spot. Canada, they have their hockey teams haven't won the NHL Stanley Cup in a while, so whatever. And let's focus on the US. Then from there, they might say, okay, what sectors do well within the US? And it's kind of this top-down approach where you go based on geography and sector. And then once you decide which industries you want to invest in, then you pick stocks that you like. So that's a very macro-focused approach because you say, well, based on inflation,
you start with macro and work your way down to the stocks that you like.
Yeah. Bottom up does the opposite approach where first they consider the fundamentals of the company and say, well, I just say Google because it's one of the easiest to think of and because we're both YouTubers. So it's not a recommendation, but just one that comes to mind.
Yeah.
Well, let's say I like Google. I like how much money they make, blah, blah, blah. Then I might consider the macroeconomic factors after the fact. And that might tilt my positions, but I've already decided what my focus of stocks will be.
Yeah. So you selected a basket and then you can look at the macro stuff and maybe remove a couple from the basket.
Yeah, exactly. And you like macro matters for individual companies as well. And funny enough, you can get kind of a macro view even just from bottom up analysis, because a lot of the time, company management will tell you about how the macroeconomic environment is impacting their business. They'll talk about foreign exchange, how that's impacting their profitability. They'll talk about inflation rates. That's a big one. You'll see it all over transcripts of, well, how is it? And a lot of earnings calls, they'll open the kind of like this. They'll open the mic to viewers and ask for questions for management. And a lot of the questions are, how is inflation impacting you? Are you seeing your costs rise? Are you passing those costs off to investors? So even if you take a bottom-up approach, you get you see a lot of macroeconomics in the investment analysis process because it's important. Like that's as simple as it is. There are a lot of factors to consider as well. Yeah. I wouldn't want to oversimplify something and say when interest rates rise, sell stocks or whatever, because I think that's way too oversimplified and not, historically speaking, correct in all contexts. But for sure, there's an influence there. You can consider it as one downwards arrow amongst a crowd of factors. Up and down arrows. Exactly. Yeah.
Yeah. So when I'm listening, because I had one question in mind. It's like, let's say there are some investors watching, but they had a background in engineering or maybe in pure finance or business or whatever, and they don't know too much about macroeconomics. What would you think, like, what's the stuff, like, what should you, besides, of course, watching One Year Macro, look for? What are the topics? So I heard you talk about exchange rates. That's probably mostly important for people like you who are living in a country with its own currency that's relatively small compared to the US, or if you invest in any of those countries. But also I heard you mention inflation is super important. How central banks work, basically, right? Because they have such a massive impact on the market these days. Maybe sort of the basics of business cycles and GDP. Am I missing?
I mean, at a high level, that makes sense, right? Like obviously you should have some understanding of economies, recessions, things like that. And to all the points you mentioned, central bank action is important. I would say interest rates are kind of the core one there. Quantitative easing and tightening is sort of an extension of that. So I think those are important ones to understand, especially in the current environment. Those are really hot topics. Inflation is one, but even just kind of more basic factors to consider as well. Things like unemployment, things like household debt is one to consider.
Yeah.
Because, at the end of the day, if you have a business that relies on consumers, well, you should see how healthy the consumer is, the average consumer is. And interestingly, we're kind of in this space where currently a lot of economists are saying the consumer is very healthy, but also their debt's really high. It's kind of this two and two. A lot of economists that I've read anyway from our providers are saying that household budgets are have a bit of a cushion, I guess. So pandemic savings from not traveling, from saving on commutes, and stimulus measures, those have offered a bit of a buffer to help with the rising costs of debt and things like that. But we also have a historically high debt load for households or even companies, and of course the government. So debt's kind of it's an interesting one because it's such a fundamental component to every economy, virtually every economy around the world. So I think having some eye to the health of the consumer and debt levels in general is important as well. But you really, you did touch on it, like exchange rates. And I would actually argue, even though Canada, very important here, because even though, as with a lot of countries, there is a country bias with investors, we probably invest more in Canadian stocks than any other country.
Yeah.
Because there are incentives and things like that. And it's sort of this familiarity, right? If you live in a city, you might understand more about the business culture and stuff. But we invest heavily in the US as well. It's easily, and as with a lot of countries, the second largest portfolio allocation will be to the US. So obviously exchange rates really matters there. And, Canada's basically moved from being at par with the US to being around kind of the 75-cent range, now a bit less actually.
Since when? Since after the pandemic, or?
Since after the pandemic, it's varied, but the US dollar currently is doing very well during the pandemic, and currently they're definitely not at par. The Canadian dollar is worth less than the US dollar on a dollar for dollar basis. Last I checked, it was $1.30 Canadian for US dollar. So, but interestingly, during parts of the pandemic, the Canadian dollar did well because we're an oil based economy, or at least oil is a very heavy component. Real estate and finance are as well, but oil is a very big part of our economy.
Yeah.
So, when we had oil prices surging past 120, the Canadian dollar did quite well because obviously oil is a big export of ours. And if oil prices are higher, the Canadian economy might make more money. It's since moderated and oil prices have come down. They're now currently under $100 a barrel. I think they're around $90 a barrel on the West Texas Intermediate. But all to say that exchange rates matter a lot for Canada. I think they matter for other investors too. And like I mentioned, I would say the majority of at least, say, S&P 500 positions, US-based positions that have international operations. So it still matters for even, again, a bottom-up investor is, companies like Google, companies like Microsoft, these big companies, they have a lot of international presence. And a lot of the time, they'll say, we did well this quarter, but FX, foreign exchange, was had a negative 2% impact on our earnings. Like that's how they'll speak about their earnings. So it still matters for even kind of the more domestic investors who might not care much about, at the end of the day, we're a very globalized economy these days. So it's kind of hard to avoid that impact. It's still important to understand, I would think.